Hello and welcome to the quarterly performance segment of Making Sense of Markets, Q3 2016. My name is Sheldon McFarland and I serve as the Vice President of Portfolio Strategy and Research at Loring Ward, and I'll be your host for this segment. Let's begin by looking at a macro view of performance around the globe. Returns often differ in stock markets around the world, and this quarter was no exception. A snapshot of performance for the third quarter shows that returns were positive in the major regional markets, with international markets outpacing U.S. markets for the quarter. The U.S. was up 4%, Latin America was up 5.4%, Europe, Middle East, Africa were up 5.3%, and Asia was up 9.3% for the quarter. Looking at performance by size and style using investment style boxes, which divide the market into 9 box tables and are meant to give an indication of how different styles performed, we see that in the U.S., small company stocks, represented by the boxes at the bottom of the chart, outperformed large company stocks, represented by the boxes at the top of the chart, with small companies earning a return premium over large companies of 5% on average. Turning our attention to international stock markets, we see small company stocks and value company stocks outperforming their large and growth counterparts, with small companies earning a 2% premium and value companies earning a 2.6% premium over their large and growth counterparts. Changing our focus from the most recent quarter to performance over the last 15 years, we see that both U.S. and international stock markets rewarded investors who stayed invested, specifically in the small and value segments, with 15-year annual premiums of 2.2% and 2.6% for U.S. small and value, and 4.6% and 0.7% for international small and value. Investors who stayed invested and followed a strategy of tilting their portfolio towards small cap and value stocks in the U.S. and international allocations of their portfolios were rewarded with higher returns than a non-tilted portfolio over this period. Those higher returns came at a price, though. The price was sticking through the worst start on record for the U.S. stock market. And with the rocky start came pronouncements from pundits, like this one from RBS, to sell everything. But those investors who persevered despite the pundits have seen significant gains through the third quarter of the year. And unfortunately for RBS, their stock tips performed about as well as their stock price. Look at the most recent quarter's asset class returns. We see that most asset classes, especially small and value companies, had pretty good returns, with the U.S. small cap leading the way with 9% return for the quarter. U.S. REITs were the only negative performer, losing 1.2% for the quarter. Maintaining a diversified asset mix, such as the 65% stock, 35% bond mix, as shown, has kept you away from the more extreme returns with significantly less volatility over this time horizon. If you're interested in reading more details about this quarter or past quarters, see our investment committee briefings for each quarter that are available on our blog site, advisorinsightsblog.com. Also, tune in to our Q3 headline segment by Matt Carvalho and long-term investing segment recorded by Pyle Farasat.